Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And for the first time in, call it 5 weeks, we're effectively starting the week on a much more positive tone than we have in the past 5 weeks or so. And we have rallied a little bit after bottoming here about a couple of weeks ago. However, the question I think for a lot of investors is, are there any legs to this rally? Can it be sustained, or are these rallies opportunities to add some bearish exposure? So let's take a look at the charts and try to help answer that specific question. So when we look at the S&P 500, we sold off quite a bit here over the past month or so, about a 10% correction in the S&P, and we're getting a decent sized bounce here, a lot of it driven off of yesterday's news that the round of tariffs that will be put in place on April 2nd will be more limited than I think what some investors were concerned about prior to the news. So we saw a pretty strong rally here yesterday, 1.75% on the S&P 500. We managed to get back above $5,700, which is pretty significant from a psychological level here. And then we have a minor resistance level here around 5750. And the question really is, can equity markets get back above that 5750 and resume a more neutral market here? Or is there a risk that this starts to pull back here and further and suggest this further downside here? And when you look at kind of the other markets here across the board, when you look at the Nasdaq 100, you have that $500 level here that we haven't managed to get back above to, meaning that not all equity markets are kind of at that pivotal juncture here. There's still a bit ways to go for technology shares to get back above 500 in order to resume a more neutral market here. Otherwise, the risk of a pullback here is still fairly elevated here right now. IWM, same thing. We haven't gotten back to that 212 and a half level here. So any rallies here, even though yesterday's 2.5% rally in small caps was encouraging, the risk still remains that there's could be further downside as it rallies off of the lows from a couple of weeks ago. And even equal weight S&P 500, as you can see, kind of starting to come towards that 50-day moving average, which also corresponds with a previous support and resistance level around 175. As you can see, this level is a pretty important level that's held so far as support and resistance, and we're just getting back to that level now as resistance. So there's quite a bit of risk as we kind of rally into these levels. And from a news perspective, yesterday we rallied on the back of the fact that concerns around tariffs were perhaps a little bit more overblown than the reality. But even today, we're hearing more of potentially of more tariffs in some of the sectors that seemed like they were going to be spared, such as the automobile industry. So these things are changing very rapidly on a day-to-day basis. It's really difficult to predict as to how much tariffs will be put in place by President Trump here over the next coming months. And unfortunately, we're sort of at the whims of that news cycle that's driving kind of investor sentiment. That's incredibly hard to predict. But the one thing that has been consistent throughout the last few weeks is really the fact that tariff uncertainty remains elevated, meaning it seems like every single week we're getting different news as to what tariffs will look like, and ultimately it has had a pretty significant change on consumer sentiment. Both consumer and business sentiment has soured pretty significantly over the last month or so. Uh, we've been talking about the fact or the risk of US consumers pulling back in terms of spending for what feels like multiple years now. Yet this is really the first time we've seen some meaningful declines in terms of consumer spending, and we're seeing it broadly across multiple categories. And that is the biggest risk that we see here with the equity rally is that if consumer sentiment and consumer spending remains weak and declines from here, that's really the biggest driver of what could be further downside here for US equities. And at the moment, the lack of uncertainty around tariffs and the fact that news around it seems to change on a near daily, sometimes even hourly basis, that uncertainty is really what's driving the significant reduction in consumer confidence and consumer spending. So at the moment, my view is that considering the fact that equity markets have not managed to clear back above major resistance levels, my base case at the moment is still looking for these rallies as an opportunity to potentially start adding some bearish exposure here in the broader markets. I'd like to be proven wrong on that, but so far that's my what I'm seeing from the data and what I'm seeing from the charts. Now let's take a look at some of the other items here. We see, value can continue to outperform growth, even though we saw a little bit of outperformance here over the last over the last week or so. Commodities continue to outperform equities as gold rallies towards new all-time highs and oil lifts off of those 52-week lows. We see the one thing that does still seem to point to a more risk-on market here is the credit bond markets here. We're seeing HYG, the high yield corporate bond market, continue to show resilience here and continue to rally and grind its way higher above that 50-day moving average after trading below it. So the bond market right now, not particularly concerned about credit risk, which does provide a bit of a tailwind here for equities. And we're starting to see, we continue to see the VIX decline here below 18% here, below the 50-day moving average. So definitely fear has receded significantly from the equity markets. And actually, I'm actually a little bit concerned at how much fear has receded, meaning investors are almost seemingly getting a little complacent here, given that the hard economic data so far has not pointed to a slowdown, but there seems to be meaningful soft data that's showing, significant pullbacks in consumer spending across a broad category of industries. So the fact that we've seen VIX come in so much leads me to believe that equity markets may be a little bit complacent here and maybe underestimating the downside risks that we see here for equities. And that represents an opportunity for option buyers. If you're looking to use put options as a way to hedge your portfolio, if you're looking as a way to buy some protection here to the downside, the reduction in the VIX means that downside protection is cheaper to buy. Yesterday's move, we did see an uptick in terms of 10-year yields back above 4.3% here. We're now 4.35. In terms of the 10-year yield, the rally that we've seen here in in bonds, have stalled a little bit here over the last few weeks after what has been a pretty strong rally in terms of bonds. This stalling here is definitely something that we are uh, aware of here. And the dollar index also, starting to fall a little bit here after some weakness here over the last couple of weeks that have drove the dollar substantially lower. We've been trading sideways here. We could start to see some another further drop here in the US dollar. Gold, as you can see, has rallied back towards a new all-time high here last week. We managed to touch 30.50. Our upside target here for gold is 3,100. And oil off of the 52-week lows, this $66, $65, $66 52-week low. So far, we've bounced off of it. Tensions in the Middle East likely will drive oil prices actually a little bit higher from where we are. So commodities overall looking quite strong here. We're seeing base metals, precious metals, commodities overall all rallying in this type of risk in the type of environment right now. And then when we look at kind of sector rotation, this is really where, you know, we're not seeing enough participation from some of the growth sectors to really kind of have confidence in the overall rally that we're looking at here. You see technology still far, far away from getting back towards kind of previous resistance levels and getting back above it to show that bulls have control of the market. Rallies here into that $225 next LK from a risk to reward perspective favors adding some downside exposure here as it continues to rally towards those important resistance level here. Same thing here in consumer discretionary. We're really far away from getting back towards some major support and resistance levels to reclaim those levels. So as we rally into those levels, the risk to reward is going to favor adding some bearish exposure here, especially if you look at the severe amount of underperformance consumer discretionary has had in the market since the end of last year. Communications is one of the strongest sectors here at the moment, continues to outperform the S&P 500. Financials have recently continued to outperform the S&P 500. So if you're looking for upside, this is definitely one of the sectors to pay attention to here right now. But, one of the things that is worrying me is that as consumer discretionary underperforms the S&P 500, traditionally when consumer discretionary underperforms, you start to see consumer staples outperform, as a more defensive sector. But what we're seeing here is that over the last couple of weeks, not only is consumer discretionary underperforming, but consumer staples is also underperforming, meaning the underperformance here is broad-based, not just in the discretionary spending categories, but even in the more stable categories, we're seeing potentially underperformance. And that is, again, the risk that I see here with the overall market for consumer spending. And that is going to be a huge driver of the equity markets overall. So the data right now is looking on the weaker side with regards to can this equity market get back above resistance levels and continue the bullish trend that we're in? That's looking less and less likely right now, based on the data that we're looking at. But overall, this is why we're here every single week, is to review this data and continue to update you and show you what the data looks like. Healthcare, finding a more defensive tone here, losing a bit of that here over the last week or so. Material, same thing, losing a little bit of that gain here in terms of defensiveness. Industrial so far still remaining fairly resilient in terms of the outperformance we've seen over the last couple of months. Same thing here for real estate and utilities. Utilities, one of the better performing sectors here right now, really speaking to the more defensive tone here in the equity rally here. So, when you look at kind of what sectors are moving and how they're moving, it still definitely reflects a much more defensive tone, a much more concerned uh, view here of equity markets, not quite the hey, everything's back to normal. Let's look at buying the dip type moves that we're seeing from the various sectors. Utilities and then home builders. We continue to see home builders underperform the S&P 500 by a very wide margin here. And semiconductors also, failing to get back of 210 is really concerning that there's some further downside here for semis as it has underperformed the S&P 500 since July of last year. So when we look at kind of everything in consensus with each other, the risks are building here with regards to downside risks. So when you're looking for investment opportunities in this particular marketplace, I think you have to be much more selective here. If you are taking long exposure in this particular market, I think going international sometimes makes some sense here right now with regards to exposure for consumer and discretionary and technology type shares, and I'll look at some of the names to share with you here, but also taking a look at some bearish opportunities here at the same time. So let's take a look at some of the trade ideas that we're looking at here for the week. The first one I want to take a look at here is Boston Scientific. This is a new bearish trade idea that we're looking at here at the moment. As you can see, Boston Scientific, this is the stock, healthcare stock that has rallied a pretty substantial amount here over the past year or so, but recently has started to break down below some support levels, and now we've rallied back to those levels as resistance, and we could potentially see this as an opportunity to start adding some bearish exposure. The thesis behind Boston Scientific is really one rooted more so in fundamentals, where also, if you look at the charts, the timing seems to align fairly well as a time to consider adding some bearish exposure, given the fact that Boston Scientific trades at a much higher valuation relative to its peers, despite the fact that it's not expected to grow any faster than its peers, and um, net margins for Boston Scientific are actually below um, the industry median. So the fact that it kind of is expected to grow slower, yet the stock is not performing, is not as profitable, yet it trades at a valuation that's nearly, 100 times higher than the average, 100% higher than the average stock in its industry, leads me to believe that there's some further downside risks in stocks like Boston Scientific. On the flip side, when you're looking on the long side, one of the stocks that we are paying attention to here right now is Ford. Now, Ford, this is a tough one because up until yesterday, our expectation was that auto stocks were going to be spared from the next round of tariffs coming into play on April 2nd. But it seems like this morning, President Trump has started to pull back on even that view here a little bit. So there are concerns that there will be some auto tariffs for select countries, but not for others. So this is a tough one at the moment because of the news cycle. But if you look at kind of the fundamentals, Ford trades at a pretty heavy discount relative to its peers, even though it's expected to grow faster than its peers. So the fact that it trades at about a 25% discount represents a fairly substantial upside. Our upside target here is around 12 and a half, which would close that gap here to the upside and get Ford back to a average valuation with the industry. So for those reasons, outside of the tariff news, Ford, as you can see, having what looks like a bit of a bottoming formation that is now broken out here. Not only has it broken out on an absolute basis, on a relative basis, it's outperforming the S&P 500. It's got everything that we would traditionally look at for a potential breakout here. The first upside target here is around 1075, which would come in around the previous resistance here. That's our first upside target. And if we can get back above 1075, then we're looking at 1250 here to the upside. So the upside potential here is fairly significant, especially given the amount of risk that you'd have to take. Because if Ford gets back below $10, I would get out and call it a day on this particular trade. So you're risking about 50 cents or so in downside to make roughly $2.25 to the upside. So the risk reward ratio here looks fairly attractive. It's a little over a 4-to-1 risk reward ratio, given if you are willing to navigate kind of what is a tricky time at the moment for automobile stocks. But like I said, I think that, looking at opportunities here right now, you have to look at, a couple of things. You got to look at potentially international stocks, such as stocks like Baidu. Um, Looking at international stocks is definitely one way to look at this. As you can see, Baidu recently has continued to make higher highs and higher lows and trend higher here. Also, more importantly, Baidu trades at a very heavy discount relative to the S&P 500, and certainly to its industry. If you look at Baidu, it's trading at about 9 times forward earnings versus 21 times forward earnings for the industry. It's expected to grow faster than the industry and it's more profitable than the industry. So the fact that it trades at about a 60% discount to the industry really represents a significant upside that we see in what is one of the leading AI plays in China. There's almost no leading AI company that's trading in the 9 times forward earnings range like Baidu is. If you look at here in the US, a lot of the leading firms are trading 30, 40, 50, sometimes upwards of even 100 times forward earnings. Baidu is virtually the exact opposite in terms of the valuation that it's trading at. We see it with Baidu, we see it with Alibaba. Those are all opportunities. The other one to take a look at here are mining stocks. We talked about Newmont Mining here last week, but as gold approaches all-time highs, mining stocks like Newmont Mining are the ones that are going to benefit from that type of um, based on the gold reaching all-time highs. As you can see, not only is Newmont Mining breaking out to the upside on an absolute basis, but on a relative basis, outperforming the S&P 500 by a very wide margin here over since the start of 2025. It's outperformed the S&P 500 by nearly 30% here in just less than 3 months. So mining stocks are a leveraged way to play the move here in commodities. So Newmont Mining is one way to look at here for a way to play gold. And then if you look at the base metals, you look at copper making kind of approaching 52-week highs. Freeport McMoran, one of the chart setups that we really like, we're starting to see in Freeport McMoran, a stock that has underperformed the S&P 500 by a wide margin, starts to show some signs of bottoming, and then starts to break out here to the upside. And what we want to see is breakout on an absolute basis as well as a breakout on a relative basis. And we're seeing both here on Freeport McMoran. So as copper approaches 52-week highs and continues to rally, beneficiaries of this are stocks like Freeport McMoran that derive about 75% of its revenue from copper mining. The largest global copper miner by market cap is one that will likely benefit if copper prices continue to rise. So, these are the types of opportunities that we think are worth paying attention to here in these types of market conditions. And then, playing more defensively as well, such as Nextera Energy, looking at the utility companies. We're seeing that rotation into utilities. Nextera Energy here starting to see some signs of higher highs and higher lows. The recent pullback here, I think, provides the better risk to reward to add some bullish exposure here to stocks like Nextera Energy, trading at only 19 times forward earnings, despite the fact that it's expected to grow faster than the industry and is far more profitable than the industry, which is what justifies, in my opinion, a higher valuation than what's trading at right now, which is only at 19 times forward earnings with net margins, approaching 30%. Very few utility companies have net margins, at those specific levels. It generates a fair amount of free cash flow that it can use and provide a bit of a downside buffer here for investors in more uncertain times. So taking a much more defensive nature in this market, taking a look at international stocks, taking a look at mining stocks, that are benefiting from precious metals and base metals. Those are the types of opportunities that I like looking at here in this type of market condition, on top of any bearish opportunities like Boston Scientific. And I'll just reiterate kind of at the moment my biggest bearish play here, which is Apple. If we think about the slowdown in consumer discretionary, Apple is at the forefront of that right now. And there's a big risk here that Apple kind of starts to continue to correct from here as it rallies back to that 220 resistance level, trading at 30 times forward earnings, even though we're only expecting EPS and revenue to grow in the high single digits. Apple has really come down significantly in terms of analyst expectations for growth. And even though they've been able to protect their net margins, at that 24%, the biggest risk is the fact that Apple has stumbled in quite a few different arenas here. Their rollout of Apple Intelligence, their AI tools, looks like we're not going to get the updates that we were promised in spring of this year. That's looking like it's not going to happen until next year, which means that even the next upgrade cycle in iPhone 17 is going to miss some of the key AI features that they were selling with the latest iPhone, and the latest iPhone did not particularly sell well, even though there was the anticipation that the new Apple Intelligence was going to come with that iPhone 16 phone. So overall, we're seeing Apple coming under pressure here for iPhone sales, and we also have seen that the Vision Pro is really just flopped as a product, and that was their big launch for their next phase of growth here. And overall, um, it seems like Meta and Snapchat are eating its lunch in that particular space. I'm sure Apple will continue to innovate in that particular space, but it very much feels like Apple's further and further behind within AR, within AI, and as a result, the company overall is suffering. And the fact that it trades at 30 times forward earnings, nearly 80% higher than the industry median, really speaks to the fact that I think that there's significant downside risks in Apple. So that's the last one I'll leave you with here for today. Like I said, the tone of the market is shifting pretty substantially, and any positive tone here that we've seen here over the last couple of weeks at the moment doesn't seem positive enough to turn around, what has started as a much more bearish tone here to the overall market. So I hope I'm wrong, but we'll continue to update you every single week here on these Tuesday morning macro outlook sessions to give you a good sense of what's happening from a macro perspective and then help you navigate it with specific trade ideas for the week. Thank you so much. I hope you guys have a great trading week, and I'll see you guys here next week.